In the shadowed corridors of global finance, where the decisions of nations can reshape economies overnight, a quiet yet profound shift is underway. As of October 2025, China's holdings of United States Treasury securities have plummeted to $688.7 billion, a level not seen since the depths of the 2008 financial crisis. This reduction, from $700.5 billion just a month earlier, marks the continuation of a deliberate strategy that has seen Beijing divest billions from what was once its largest foreign asset class. It is a move that echoes the mobilization of a financial army, not with tanks or troops, but with the calculated sale of bonds that underpin the world's most powerful economy. This is not mere portfolio adjustment. It is a recalibration of power in an era of escalating geopolitical tensions. To understand the gravity of this development, we must journey back through the annals of economic history, unravel the mechanisms at play, and explore the far-reaching consequences for nations around the globe. Let us begin by establishing the fundamentals, for even the most seasoned observers benefit from clarity in these complex matters. United States Treasury securities, often simply called Treasuries or U.S. bonds, are debt instruments issued by the U.S. government to finance its operations. They come in various forms: short-term Treasury bills, medium-term notes, and long-term bonds, each with maturities ranging from a few months to 30 years. These securities are considered among the safest investments in the world because they are backed by the full faith and credit of the United States, meaning the government pledges to repay the principal and interest without fail. Investors, including foreign governments, purchase them not only for their security but also for their liquidity. They can be bought and sold easily on global markets, and for the steady interest payments they provide. Why do countries like China accumulate vast quantities of these bonds? The answer lies in the management of foreign exchange reserves. When a nation exports more goods and services than it imports, it accumulates surplus dollars or other currencies. For China, whose economy has long been export-driven, this surplus has historically been invested in US Treasuries to preserve value, earn a modest return, and maintain stability in its own currency, the renminbi, also known as the yuan. Holding Treasuries allows a country to influence exchange rates. By buying dollars to purchase these bonds, China has kept the yuan relatively weak, making its exports cheaper and more competitive on the world stage. This practice is part of a broader strategy known as currency manipulation, though Beijing has always denied such accusations, framing it instead as prudent reserve management. China's relationship with US Treasuries did not emerge in a vacuum. It traces its roots to the late 20th century, but it accelerated dramatically in the early 2000s as China's economy boomed. Following its entry into the World Trade Organization in 2001, China's exports surged, flooding global markets with everything from electronics to textiles. By 2008, on the eve of the global financial crisis, China's holdings stood at approximately $521 billion in long-term treasuries alone, according to detailed surveys from that period. This figure represented a significant portion of its growing reserves, which were swelling due to trade surpluses with the United States and Europe. The 2008 financial crisis, triggered by the collapse of the U.S. housing market and the failure of major financial institutions like Lehman Brothers, marked a pivotal moment. As panic gripped world markets, investors fled to the safety of U.S. Treasuries, driving down yields, the interest rates paid on these bonds, and underscoring their status as a global safe haven. Ironically, amid the turmoil originating in America, foreign holders like China increased their purchases. By October 2008, China's holdings had risen to around $684.1 billion, providing crucial liquidity to the U.S. government as it bailout out banks and stimulated the economy. This influx of foreign capital helped stabilize the dollar and kept borrowing costs low for the U.S., allowing it to weather the storm without immediate hyperinflation or default. In the years following the crisis, China's appetite for U.S. debt grew insatiable. By 2010, its holdings surpassed $1 trillion and they peaked at approximately $1.3 trillion in 2013. This accumulation was fueled by several factors. First, China's export machine continued to churn, generating massive trade surpluses, often exceeding $300 billion annually with the U.S. alone. Second, the U.S. Federal Reserve's quantitative easing programs, which involved buying vast amounts of treasuries to inject money into the economy, kept yields low and made these bonds attractive. Third, Beijing viewed treasuries as a hedge against domestic economic risks such as overinvestment in infrastructure or property bubbles at home. Yet even at this zenith, cracks began to appear. Analysts noted that China's heavy reliance on U.S. debt exposed it to risks. Fluctuations in the dollar's value could erode the worth of its reserves, and political tensions might one day weaponize these holdings. Beijing started diversifying subtly, increasing investments in gold, European bonds, and assets in emerging markets. This diversification was not abrupt but methodical, reflecting a long-term shift toward reducing dependence on the U.S. financial system. The turning point came in the mid-2010s as U.S.-China relations soured. Under President Barack Obama, the U.S. pivoted to Asia, strengthening alliances to counter China's rising influence. But it was during the Trump administration, beginning in 2017, that trade frictions escalated into a full-blown trade war. Tariffs were imposed on hundreds of billions of dollars in Chinese goods, prompting retaliatory measures from Beijing. Amid this, China's Treasury holdings began a gradual decline. By 2020, they had dipped below $1.1 trillion, influenced by the need to support the yuan during economic slowdowns exacerbated by the COVID-19 pandemic. The pandemic itself added layers of complexity. As global supply chains fractured and economies locked down, China's exports paradoxically boomed, driven by demand for medical supplies and electronics. Yet Beijing used this period to accelerate diversification. Holdings fell to around $1.07 trillion by the end of 2020. The U.S., meanwhile, issued trillions in new debt to fund stimulus packages, diluting the relative share of foreign holders. Entering the 2020s, the decline gathered pace. By December 2024, China's stash stood at $759 billion, a significant drop from previous highs. Several months in 2024 saw net sales attributed to rising U.S. interest rates, which made holding low-yield treasuries less appealing, and to Beijing's efforts to bolster its domestic economy amid property sector woes and slowing growth. But it is in 2025 where the reduction has intensified, bordering on what some observers describe as a strategic dump. January 2025 saw a modest dip, but by July holdings hit $696.9 billion, the lowest since 2008 at that point. September brought another decline to $700.5 billion, and October's drop to $688.7 billion confirmed the trend. This represents a reduction of over $70 billion in just the latter half of the year, part of a broader sell-off that has seen China offload more than $100 billion in treasuries over the past 12 months. To visualize this trajectory, consider a line chart depicting China's U.S. Treasury holdings over time. The data points reveal a steady climb from around $650 billion in 2008, peaking at $1.3 trillion in 2013, followed by a plateau and then a sharp descent to below $700 billion by late 2025. This visual underscores the deliberate nature of the shift, not a panic sell-off, but a calculated repositioning. What drives this acceleration in 2024 and 2025? Surface explanations point to economic pragmatism. China faces domestic challenges, a sluggish post-COVID recovery, deflationary pressures, and a real estate crisis that has sapped consumer confidence. Selling treasuries frees up dollars to intervene in currency markets, preventing the yuan from depreciating too sharply amid capital outflows. Additionally, with U.S. interest rates rising due to the Federal Reserve's inflation-fighting measures, the opportunity cost of holding low-yield bonds has increased. Beijing has redirected funds into higher-return assets, such as gold. China's gold reserves have surged in recent years, or investments in Belt and Road Initiative projects abroad. Yet beneath these economic rationales lie deeper, less discussed factors rooted in geopolitics and strategy. The renewed U.S.-China trade tensions under the second Trump administration, which began in January 2025, have played a central role. Tariffs on Chinese imports, including electric vehicles and semiconductors, have escalated, prompting Beijing to retaliate not just with countertariffs but with financial maneuvers. Dumping treasuries can be seen as a subtle form of economic pressure, signaling to Washington that China holds leverage over U.S. borrowing costs. If demand for treasuries wanes, yields rise, making it more expensive for the U.S. to service its $35 trillion national debt. Another hidden element is the fear of asset freezes. The U.S. and its allies froze Russian reserves following the 2022 invasion of Ukraine, a move that sent shockwaves through Beijing, Chinese policymakers wary of similar. Are sanctions in a potential Taiwan conflict or other flashpoints have accelerated diversification to mitigate risks. This includes boosting holdings in euros, yen, and even cryptocurrencies, though the latter remains experimental. Moreover, China's push for renminbi internationalization is a long-term play. By reducing reliance on dollar-denominated assets, Beijing aims to elevate the yuan as a global reserve currency. Initiatives like the Cross-Border Interbank Payment System, CIPS, and digital yuan trials facilitate trade in non-dollar terms, chipping away at the dollar's dominance. This is not overt confrontation but a patient erosion of the post-World War II financial order centered on the US. There are also environmental and technological undercurrents. China's green energy ambitions require massive investments in rare earths and battery technologies, diverting capital from foreign bonds. Additionally, U.S. export controls on advanced chips have forced Beijing to invest domestically in semiconductor self-sufficiency, further straining reserves and necessitating asset sales. Now let us examine the step-by-step mechanics of how China executes these sales. The process begins with the People's Bank of China, PBOC, the central bank which manages the bulk of reserves. When deciding to sell, the PBOC instructs state-owned banks or offshore entities, often in places like Belgium or the Cayman Islands, to offload treasuries on secondary markets. These sales are typically gradual to avoid spiking yields abruptly, which could boomerang and devalue remaining holdings. For instance, the October 2025 drop of $11.8 billion was executed through a mix of maturing bonds not rolled over and direct sales. The US Treasury Department tracks these through its Treasury International Capital Tick system, releasing monthly data on foreign holdings. This transparency, while useful for markets, also allows Beijing to signal intent without explicit declarations. In parallel, China has increased purchases of agency debt, like that from Fannie Mae, or shifted to shorter maturity bills, altering the composition rather than a wholesale exit. Hidden in these transactions are the roles of intermediaries. Some sales are disguised through third-party custodians, making exact attribution challenging. For example, increases in UK holdings, up to $877.9 billion in October 2025, may partially reflect Chinese assets parked in London. This opacity adds a layer of strategic ambiguity, allowing China to downplay the aggressiveness of its moves. The implications for the United States are multifaceted and warrant careful dissection. At first glance, a reduction in foreign demand for treasuries could push up yields. Each percentage point increase in interest rates adds hundreds of billions to the U.S. debt servicing costs over time. With the federal deficit already exceeding $2 trillion annually, this could exacerbate fiscal pressures, potentially forcing cuts in social programs or tax hikes, measures that are politically fraught. However, the impact has been muted thus far. Other buyers, such as Japan, whose holdings stand at $1.2 trillion, and the UK have stepped in, absorbing supply. Domestic investors, including pension funds and the Federal Reserve, hold the majority of U.S. debt, providing a buffer. Moreover, a weaker dollar from Chinese sales could boost U.S. exports, countering some trade deficits. Yet, in a worst-case scenario of rapid dumping, markets could seize. Yields might spike, as seen in April 2025 when speculation of Chinese sales contributed to volatility. This could ripple to mortgages, car loans, and corporate borrowing, slowing economic growth. The dollar's status as the world's reserve currency might erode, raising costs for global transactions. Globally, the ramifications extend far beyond bilateral ties. Emerging markets heavily indebted in dollars could face crises if rates rise, reminiscent of the 1997 Asian financial crisis. Europe's economies, intertwined with both powers, might see currency fluctuations. A stronger euro against a weaker dollar could hurt exporters like Germany. In Asia, allies like Japan and South Korea monitor closely, balancing their own treasury holdings against alliance obligations. South Korea, for instance, increased its purchases in 2025, offsetting some Chinese sales. Africa and Latin America, recipients of Chinese loans via the Belt and Road, might experience shifts in financing as Beijing reallocates capital. On the geopolitical stage, this financial maneuver heightens tensions. It underscores the weaponization of interdependence. China's nuclear option of dumping treasuries, though self-damaging, serves as deterrence. A massive sell-off could depreciate the dollar, making U.S. imports costlier and inflating prices, but it would also appreciate the yuan, hurting Chinese exports. This mutual vulnerability fosters a delicate balance where neither side fully escalates. Environmentally, diverted funds could accelerate China's green transition, influencing global climate efforts. Technologically, reduced dollar reliance might spur innovations in blockchain-based settlements, challenging SWIFT's dominance. As we draw this examination to a close, reflect on the profound interdependence that defines our era. China's reduction of U.S. Treasury holdings to levels unseen since 2008 is not an isolated event but a symptom of a shifting world order. It signals Beijing's quest for autonomy in a multipolar landscape where economic tools rival military might. For the United States, it is a reminder of the perils of unchecked debt and the need for fiscal discipline. Globally, it portends a future where currency wars could eclipse trade wars, reshaping alliances and economies. Yet amid these tensions, opportunities emerge. Dialogue on debt sustainability, perhaps through forums like the G20, could mitigate risks. Diversification by all nations might lead to a more resilient financial system, less beholden to any single power. In the end, this financial mobilization by China invites us to ponder. In a world of interconnected fortunes, can true victory come from decoupling, or must we forge paths of cautious cooperation? The answers will unfold in the years ahead as markets and policymakers navigate this uncharted terrain. As we approach the close of 2025, the most recent official data from the United States Treasury Department, released in mid-December, confirms that China's holdings of US Treasury securities stood at approximately $688.7 billion as of the end of October. This figure represents the lowest level since late 2008, underscoring the persistence of a trend that has seen Beijing systematically reduce its exposure to American debt instruments over the past decade and a half. To place this in fuller context, the trajectory in recent months has been one of consistent, albeit measured, divestment. From June through October 2025 alone, China's holdings declined by roughly $44 billion, with notable reductions in July, when sales exceeded $25 billion, and further decreases in subsequent months. While data for November 2025 will not be available until mid-January 2026, preliminary market indicators and analyst assessments suggest that the pattern of reduction has likely continued, driven by the same confluence of economic and strategic imperatives that have shaped Beijing's actions throughout the year. One of the less discussed aspects of this ongoing divestment is the parallel accumulation of alternative assets, particularly gold. Throughout 2025, the People's Bank of China has maintained an unbroken streak of gold purchases, extending into November with additions that have bolstered its official reserves significantly. This shift is not coincidental. It reflects a deliberate strategy to enhance the resilience of China's foreign exchange portfolio against dollar-centric risks. Gold, as a non-yielding but historically stable store of value, serves as a counterweight to the interest-bearing but politically vulnerable treasuries. By reallocating proceeds from treasury sales into bullion, Beijing not only diversifies but also signals a broader move toward assets less susceptible to unilateral actions by Western financial authorities, such as the asset freezes imposed on Russia in 2022. This diversification extends beyond gold. China has incrementally increased its holdings of other currencies, including the euro and yen, and invested more heavily in physical commodities and infrastructure projects under the Belt and Road Initiative. These moves are facilitated by mechanisms like the renminbi-denominated trade settlements, which have grown substantially, allowing China to conduct an increasing share of its international commerce without relying on dollar intermediation. In essence, the sale of treasuries is funding a multifaceted effort to insulate the Chinese economy from potential disruptions in the dollar-based system. The global implications of this continued mobilization are profound and multifaceted. For the United States, the absence of China's once insatiable demand for treasuries contributes to upward pressure on borrowing costs at a time when the national debt has surpassed $35 trillion and annual deficits remain elevated. Although other nations, notably Japan with holdings around $1.2 trillion and the United Kingdom approaching $900 billion, have partially filled the void along with domestic buyers, the overall foreign appetite for new U.S. debt issuance is tested. In periods of market stress, this could manifest in sharper yield increases, elevating the cost of everything from government operations to consumer mortgages and business loans. On a broader scale, China's actions accelerate the fragmentation of the global financial architecture. As the dollar's share of global reserves gradually declines, from peaks above 60% to lower levels in recent surveys, alternative systems gain traction. The BRICS nations in particular have explored expanded use of national currencies in trade and even discussions of a common payment mechanism. While these initiatives remain in early stages, the reduction in dollar asset holdings by members like China provides practical momentum. Emerging economies watching this process may follow suit, particularly those wary of sanctions risks or seeking to hedge against dollar volatility. Hidden within these dynamics are the environmental and technological dimensions. Funds redirected from treasuries support China's ambitious investments in renewable energy, critical minerals, and advanced manufacturing. This not only bolsters domestic growth amid property sector challenges, but also positions China as a dominant player in the green transition, influencing global supply chains for electric vehicles, solar panels, and batteries. Technologically, reduced dollar dependence encourages innovation in financial infrastructure, such as digital payment systems and blockchain-based cross-border settlements, potentially challenging established networks like SWIFT. Yet it is essential to recognize the constraints on both sides. A precipitous dump of remaining treasuries would inflict losses on China itself, through depressed bond prices and a stronger yuan that could undermine export competitiveness. Similarly, the United States retains significant leverage through its control of the world's primary reserve currency and the depth of its financial markets. This mutual assurance of destruction maintains a precarious equilibrium, where financial maneuvers serve more as signaling than outright warfare. In reflecting on this mobilization of China's financial resources, we confront a pivotal transformation in international relations. What began as a symbiotic relationship, China financing American consumption through surplus recycling, has evolved into a more guarded coexistence marked by strategic decoupling. The plunge to post-2008 lows in Treasury holdings is emblematic of this shift, driven not by panic but by calculated foresight. The long-term consequences may redefine global stability. A more multipolar currency system could foster competition and innovation in finance, reducing the risks of over-reliance on any single nation. Conversely, it might introduce volatility as markets adjust to diminished dollar hegemony. For policymakers in Washington and Beijing alike, the challenge lies in managing this transition without triggering cascading disruptions. Ultimately, this episode invites contemplation of the fragility and resilience of economic interdependence. In an age where financial assets can serve as instruments of influence rivaling traditional power projections, nations must navigate with prudence. China's deliberate retreat from US Treasuries to levels reminiscent of the crisis era does not herald immediate catastrophe, but rather a gradual rebalancing. Whether this leads to a more equitable global order or heightened fragmentation remains uncertain. What is clear is that the decisions made in reserve rooms and central banks today will echo through economies for generations, reminding us that in the realm of international finance, patience and strategy often prevail over force. As 2025 draws to a close, the world watches to see how this financial army's next moves will shape the contours of the coming decade. As December 2025 draws to a close, the most recent authoritative data from the United States Department of the Treasury, released on December 17, confirms that China's holdings of Treasury securities stood at $688.7 billion as of the end of October 2025. This marks a reduction of approximately $11.8 billion from the September figure of $700.5 billion, continuing a pattern of deliberate divestment that has persisted throughout the year. Data for November 2025 will not be available until mid-January 2026, but market observers and preliminary indicators suggest that the trajectory of gradual reduction is unlikely to have reversed abruptly in the intervening period, given the ongoing domestic economic pressures in China and the persistent geopolitical frictions. This October level represents not only the lowest since the immediate aftermath of the 2008 financial crisis, but also a stark illustration of how far China's exposure to U.S. debt has diminished from its historical peaks. To appreciate the scale, recall that at the height in 2013, these holdings exceeded $1.3 trillion, serving as a cornerstone of the interconnected financial relationship between the world's two largest economies. The decline of more than $600 billion over the subsequent 12 years reflects a profound strategic reorientation, one that has accelerated in recent periods amid heightened uncertainties. A closer examination of the 2025 data reveals a year characterized by episodic but consistent sales. Earlier reductions included a notable drop in July to $696.9 billion, influenced by the need to stabilize the yuan against capital outflows and to reallocate resources toward domestic stimulus measures. Subsequent months saw further adjustments, culminating in the October figure. While some fluctuations occur due to maturing bonds not being reinvested, the net trend points to active management by the People's Bank of China to lower vulnerability to dollar-denominated assets. Parallel to this divestment, Beijing has pursued an aggressive accumulation of gold, extending its buying streak into late 2025. Reports indicate continued purchases in November, adding to reserves that now provide a substantial non-dollar hedge. This dual approach, selling treasuries while acquiring physical commodities, enhances the diversification of China's nearly $3.3 trillion in foreign exchange reserves, reducing exposure to potential sanctions or dollar volatility while preserving overall portfolio value. The mechanics of these sales remain opaque by design, often rooted through custodial centers in Europe or offshore financial hubs to minimize market disruption. Increases in holdings attributed to countries like the United Kingdom or Belgium frequently mask underlying shifts by Chinese entities, adding ambiguity that serves Beijing's strategic interests. This method allows for steady offloading without triggering sharp spikes in U.S. yields that could adversely affect the value of remaining holdings. For the United States, the implications continue to unfold gradually rather than catastrophically. Foreign holdings overall dipped slightly to $9.243 trillion in October, yet remained robust, supported by purchases from allies such as Japan, which increased to $1.2 trillion, and South Korea, which has emerged as a significant buyer in recent months. Domestic demand from pension funds, insurers, and the Federal Reserve itself absorbs much of the new issuance, mitigating immediate pressures on borrowing costs. Nonetheless, in an environment of persistent federal deficits exceeding $2 trillion annually, any sustained withdrawal of foreign demand contributes incrementally to higher yields, elevating the long-term cost of servicing a national debt that has surpassed $35 trillion. On the global stage, China's actions contribute to a broader realignment in reserve management practices. Other emerging economies, observing the precedents set by sanctions on Russian assets and the escalating US-China rivalry, are similarly diversifying away from concentrated dollar holdings. This collective shift, though gradual, erodes the dollar's unchallenged dominance in international reserves, fostering conditions for a more fragmented financial order where alternative currencies and assets gain prominence. Less visible but equally significant are the linkages to technology and energy security. Proceeds from Treasury sales bolster investments in critical sectors, from semiconductor fabrication to rare earth processing and renewable infrastructure. These allocations not only address immediate growth challenges, such as the lingering effects of the property downturn, but also position China to lead in industries vital to the 21st century economy, influencing global supply chains and standards. In contemplating the broader narrative, this financial mobilization represents more than balance sheet adjustments. It embodies a calculated assertion of sovereignty in an interdependent world. Beijing's reduction to post-2008 lows is a measured response to perceived risks, prioritizing resilience over the yields once offered by treasuries. For Washington, it underscores the imperatives of fiscal prudence and the cultivation of diverse investor bases to sustain the dollar's privileged status. As we reflect on these developments at the threshold of a new year, the interplay of economic necessity and geopolitical strategy becomes ever clearer. The era of unquestioned Sino-American financial symbiosis has given way to one of cautious disentanglement, where each move carries implications far beyond bilateral accounts. A rapid escalation remains improbable, constrained by mutual interests, yet the trend toward multipolarity persists. In this evolving landscape, nations must weigh interdependence against autonomy, seeking equilibria that avert disruption while accommodating change. The path ahead will likely feature continued diversification, incremental shifts in reserve compositions worldwide, and periodic tests of market resilience. Whether this transition yields a more stable, pluralistic system or introduces new volatilities depends on the prudence of policymakers in both capitals and beyond. What endures is the recognition that in modern great power relations, financial instruments wield influence comparable to traditional levers of power, shaping outcomes through persistence rather than proclamation. As 2025 concludes with China's Treasury holdings at these subdued levels, the world is reminded that profound transformations often unfold not in dramatic ruptures, but in the quiet recalibrations of ledgers and strategies. The coming years will reveal whether this mobilization heralds a new equilibrium or merely the prelude to further reconfiguration in the architecture of global finance.